Canadian Natural Resources is making headlines with their acquisitions in the Canadian oil sands. While all these other major oil companies exit the market, Canadian Natural seems to be going all in. My question today, is this a good move? Will this be the reason that Canadian Natural ends up the next king of oil? Welcome in everybody to Golden Larch Investing. My name's Liam, and today we're going to be really exploring the recent string of investments made by Canadian Natural Resources. We're going to talk about the reasons behind them. We're going to talk about what the oil sands are. What exactly are the Canadian oil sands? We'll talk about how sort of they're existing in the present day, the struggles that are convincing other companies to sell, what exactly CNQ is getting with these purchases, and how these purchases are going to impact CNQ's bottom line. Finally, we're going to talk about what I think of the company from the perspective of a neutral investor who has not bought this company yet. So I'm going to start off by telling the story of Canadian oil sands. So who are these guys? And the Canadian oil sands is really quite a story. I know it really well. My family's lived in Alberta for 3 generations, and like most Albertan families, there's plenty of people in my family who have worked in the oil industry. Today specifically, we're really talking a lot about the Athabasca Oil Sands Project, which really does represent the whole sort of field. It's a giant oil sand in the far north of Alberta, and it's historically been fertile ground for companies like Chevron and Shell to invest heavily into this province. This includes these massive operations like the Muskeg River operation, the Jack Pine Mine, and I'm going to just have to toss some images on screen to show you the scale of what we're really talking about here, just how massive these projects are, the amount of effort that goes into these, the amount of investment that goes into these in order to get oil. Problem is, in the 2020s, these companies have really largely been divesting their investments. So they've been getting rid of what they have in the Canadian oil sands. And it's thanks to this transition from an era of growth to an era of sustainability. We're not really growing the way we have been. Instead, we're really trying to keep profitability and we're trying to get through this period. And really, the company that's done the best at this has been Canadian Natural Resources. And because of that, they've had the opportunity to consolidate a lot of the oil sands. Canadian Natural Resources, really interesting company. This is an independent oil company, Canadian, obviously, founded way back. And they've gone through a million different acquisitions over the decades. They're mainly operating out of Western Canada, where they explore, develop, and produce crude oil, as well as other sort of liquids and natural gas. They have a really strong management team, it seems. They've made some really, really solid profits, and they've been willing to take on debt, make big moves, acquire competitors. And that's why these guys really today, I think, are the number one player in the Canadian oil sands. As far as producers go, they're really, really well known for running lean operations, and they make a strong profit. That is their skill. And in this system of efficiency, they're on top. So in order for us to understand if we like these acquisitions, if we think they're positive or negative, we got to understand why everybody else is selling. And first and foremost, we can't avoid the topic. There are huge environmental regulations right now in Canada. We got carbon pricing. We've got sort of a government that dislikes the Canadian oil industry. And with all of this happening at the same time as the industry turns towards efficiency, it makes investment into Canadian oil much less attractive, especially when there are other options with a higher return on investment just across the border. Speaking of these other options, Chevron specifically have mentioned their renewed focus in the more profitable Permian Basin down in the US, where they can achieve a higher return with fewer regulatory hurdles. Last, but not really least, there are these calls for international firms to reduce their carbon footprint and invest into renewable energy instead of these high carbon assets. And something like an oil sand is not a great thing PR-wise for some of these companies that are trying to say, oh, we're the energy companies of the future, which has been a big play by a lot of these big firms. And so they've allowed other companies to sort of consolidate ownership at what seem to me like real discount prices. The real headline here is the recent Canadian Natural acquisition of Chevron's 20% of the Athabasca Oil Sands project. They also got 70% of Dividend and Shell. It cost Canadian Natural about $6.5 billion, and it's expected to boost their production by 122,500 barrels of oil per day by just next year. So massive acquisition, a lot of oil. And Canadian Natural actually has a history of acquisitions like this, such as the time they purchased 60% of the Athabasca Oil Sands project from Royal Dutch Shell and Marathon Oil. They also own several undeveloped oil sands leases. They've got other oil infrastructure in and around the region. They've really focused on this sort of region in northern Alberta, consolidating a huge amount of resources. And I really think this deal has some huge benefits for CNQ, and it might end up huge for the company. And that's for a couple of reasons, really. First and most obviously, there's like an enhanced production capacity. Canadian Natural now owns 90% of the Athabasca Oil Sands project, which means they have basically one strong, centralized asset to focus on. And from this, they have synthetic crude from the Scotford upgrader, the Dividend facility, and more. So it allows them to boost the output oil and natural gas to meet whatever demand really is coming their way. So really centralized, really strong ability to meet demand, and demand is going to offer some real operational synergy and cost efficiency, so they can streamline their portfolio, and they can be more and more able to keep costs low, use economies of scale to their advantage, and this should improve their long-term, so like long out free cash flow, since these are profitable assets that are going to be bringing cash in for this company by just next year. And considering this is closing in the fourth quarter, that's huge. So it should give CNQ, Canadian Natural, the ability to increase shareholder returns, have minimal drawbacks. They have more free cash flow to play with. They can increase their dividend. They can continue to buy more assets at these discounts. I think, honestly, this is pretty great. However, I think there's one thing that is even bigger for CNQ right now, and that's that right now, they are essentially the top dog in the Canadian oil space. This is a homegrown company with large assets and an incentive to invest into the Canadian energy market. As everything is discounted, as these other firms struggle or divest these assets, they're going to be giving them away to CNQ, who now stands to benefit in the case of a more friendly government coming to power or other things changing, allowing for this market to continue another growth stage. With these acquisitions, though, they're going to be really dependent on oil. And I think with things like Trans Mountain Pipeline coming online, with all of the conflicts in Russia, in the Middle East, and with polling showing a conservative majority government probably coming to Canada in the next year or so, the oil market might be set up for a major rally for the next 10 or so years. And investors can never feel too confident. It's important to remember oil markets are always on a knife's edge, and any crash could happen at any time for any reason. So diversification is still key here, but choosing to invest in a company like CNQ, who's at the top of their game, who's the top dog right now, might make it easier for your portfolio to ride out any downtrends. My final thoughts on this story are pretty simple. The Canadian oil market today is really tough for producers, and it makes sense for a lot of these major international players to get out. I think their shareholders should probably be happy with the decisions that people like Shell have made, and the people like Chevron have made. But for a company like CNQ, having the opportunity to consolidate their position in Canada, to build free cash flow, to build efficiencies, to be an excellent dividend payer, and to just sit back and wait for the next opportunity to boom in these Canadian oil sands, I think this has to be in my portfolio. And considering I'm investing in Canadian dividend paying companies, I love the idea of being able to invest into the Canadian economy. These guys are just a natural fit for me. And that's really all I have to say today. I really hope you found this interesting. I hope you found this video valuable. If you're interested in this kind of stuff, we explored recently the story of Pembina Pipelines, which is one of the fastest Canadian pipeline companies. They've done a huge amount of acquisitions, and they're like set up maybe to buy Trans Mountain. I don't know. Check out the video. I'll post it right up here. And if you like the channel, please like and subscribe. We're really out here learning and growing, trying to figure out a little bit more about the Canadian economy, and the best ways that we as investors can profit from this economy, and invest at home here. So if you enjoyed this, I hope you have a good one.